Derivative in general terms stands for any financial instruments that derives its value from something others. So it has three characteristics. First is fair value of derivative changes in response to the changes in one or more underlying variables. And there is no or little investment requirement for derivatives, and it is settled at a future date. So all of these three characteristics are satisfied. In that case only we will call a financial instrument as a derivative, and derivative will always be measured at fair value, and any change in the fair value to be recognized in profit and loss account, except for the hedge accounting that we have discussed in separate videos. You can refer that. So let's discuss some example of derivatives. For example, there is an interest rate swap. So the value of interest rate swap will be varied according to the main variable, that is rate of interest. If the rate of interest is increased and is decreased, based on that the value of derivative of interest rate swap will be changed. If there is a forex forward contract, so the value of the forex forward contract will be varied according to the changes in the foreign exchange rate. If there is a commodity options, so the value of the commodity options will vary according to the price of the commodity. Similarly, in case of call or put option, the value of the derivative will be moved upward or downward based on the price of equity. Embedded derivative is a combined instrument that we call hybrid instrument that also has a non-derivative host contract and a derivative embedded in the host contract. So it is a component of hybrid contract that also includes a non-derivative host, with the effect of some of the cash flow of the combined instrument vary in a similar way to a standalone derivative. So it is a hybrid instrument having a non-derivative host and a derivative embedded in it. So, but a derivative attached to a financial instrument, but if the it is contractually transferable independently or has a different counterparty from that instrument, it means it has its own identity separately. So it will not be called as a embedded derivative. Let's take some example. If a company hold bond that is convertible into ordinary share of another company, in that case the hybrid contract is convertible bond, and the host will be called as a bond asset because bond is the convertible in shares, ordinary shares, and the embedded derivative is conversion option. Because of the conversion option, the standalone value of the bond is different as compared to the convertible option embedded in it. Similarly, if a company enters into a lease contract with the inflation factor, because of that rental to be adjusted according to the risk price index every year. In this case, the hybrid contract is a entire lease, and the is lease contract, but the embedded derivative, because of that value is going to be the change of the contract, is the risk price index adjustment. Let's take another example. If a company sells PPE to another company for USD $1 million, and the contract is to be adjusted in USD. In this case, the entire contract is a hybrid contract and host is sale contract, while the embedded derivative is the forex transaction where it is to be settled in foreign currency, and because of that price will be keep on changing. For deciding separation of embedded derivatives, if a contract is outside scope of Ind AS 109, or if it is financial liability, in that case we need to separate the embedded derivative from the host, but it is allowed only if the economic characteristics and the risk are not closely related of host and derivatives, and the separate contract would meet the definition of derivative, and the hybrid instrument is not measured at fair value. For example, if the liability is measured at fair value, the embedded derivative is not separated. So if we are going to separate it, we need to apply measurement rule separately for host and derivatives. And if it is not possible to separate the host and derivative, in that case we need to measure complete instrument as FETPL approach. And in case of the financial asset, we need not to separate, we will not separate the derivative and host. And in this case, we will apply measurement rule to entire hybrid contract. Apart from it, these requirements of separation of host and derivatives apply from to both the issuer and the holder. And if the both parties to a and in this, the both parties to the contract may reach a different accounting conclusions.